Hi, folks, and welcome to another episode, I guess, of Trader Cafe. I'll just move you guys around so you can see me, and I'm not in very sunny Auckland because it's nighttime here. But what I might do is I might just X out some of those backgrounds to make it a little bit less, let's go a bit blurry, and hopefully just try and improve things a bit. There we go, much better. Let's have a picture of our famous Milford Sound in the background. Thank you everybody for coming in. Today's Trader Cafe is going to be really talking about the current market. So we're going to have a quick scoot round and have a view, I guess, about what's happening out there at the moment. And we're going to start really, I think, with one big caveat and one big proviso. There is a problem. But there's a couple of problems in the world right now. There's always problems in the world, but the major one that's obviously on everybody's mind is what the Russians are going to do in Ukraine and what impact that could have on the market. So big disclaimer I'm going to give as we go through this presentation. The things I'm going to talk about, I'm going to refer to as happening in a normal marketplace. Very clearly what could happen here is that the market becomes very much unnormal as we progress through what is potentially a serious conflict emerging in Ukraine. Now, there's lots of people who are saying it's never going to happen. There's lots of people who are saying it's going to happen. And the short answer is I'm a trader. I'm not very well qualified to be able to answer either of those questions. But what I do know is if it does happen, we'll deal with it when it does. Now, traditionally, the markets will not handle a conflict position very well. We've already seen the last few weeks it's been nervous. And as the Russians have continued their build-up of troops and the risk of invasion gets closer and closer, then the market has traded commensurately lower in a lot of asset markets around the world, most notably the stock market, and especially in the States. As we know, it's quite expensive and it's vulnerable to a correction. We're not at cheap levels at the moment. So realistically, does happen. I expect there to be an initial movement. After that, the markets will settle down depending on how the outcome of the conflict is going and who gets dragged into it. And really, from a trading perspective, it's going to be very much one of trading day to day. And I wouldn't recommend running any medium-term positions unless you have substantial stop losses, just simply because volatility could creep up and it could be amazingly difficult to trade for a few days. So look, guys, that's the caveat and the disclaimer I have over everything I'm going to say really for the next half an hour or so. On the assumption that the Russian conflict resolves itself, then I think the outlook isn't actually as bad as people are thinking, and there may be some opportunities really to think about the markets in a more rosy light. And as a result of that, I have in the short run have the short sellers overdone themselves to the downside, and are we in the situation whereby this is a trading opportunity that we could take advantage of? Okay, so let me just try and pull up my screen and get to a point where we can all see it. So just bear with me for 2 seconds as we get the screens going. I've just got a couple of slides I really want to show you guys about my current thoughts at the moment. So just hold on 2 seconds while I get this organized. Okay, now hopefully everybody can see the screen in front of you. Just sharing it. If somebody could just give me a shout and just say yes, I can see the slides, that would be brilliant. Awesome. Thanks very much. Appreciate that, everybody. And look, as always with this, this is an interactive discussion. If you've got some points you'd like to make, something you'd like to bring up, then please really just ask me questions as we go along. We're going to be looking this time around mostly at foreign exchange markets with some brief mentions about some of the other markets and what I'm seeing there, where some of the opportunities lie as well too. And this maybe gives you a bit of a flavor about how I think. So as always, we have to put the disclaimer on. Please, everybody, this is an educational show. Please speak to a financial advisor if you're not sure what you're doing. And sometimes when you buy and sell things, you can do it and lose some money. Hopefully with us, that won't be the situation, but it's a possibility and you're doing it on your own. So with your own decision making. So look, I think the key thing for me as we start this process is to ask, has the bear market in stocks finally arrived? This is the one that everybody's been talking about. Okay, so, I think it doesn't take a genius, anybody who's reading the headlines right now will just obviously say, look, things are happening. There's been a bit of a sell-off, and if you've owned some of the second tier Nasdaq stocks or the Russell 2000 stocks, I think you definitely know what a bear market looks like for the last 15 months. So those stocks aside, what I'm looking at and what my thoughts are is to really look at the indexes. So where things have been bid up to crazy levels and they've come back to normal levels, then realistically those corrections are a bit greater. And I think rather than individual stock basis, what I'm always concerned about are the indices, because that's what we've got the best history for. So has the bear market arrived? Well, look, I think there are three things which have happened to cause some people some pause around this, right? So the first one is the Fed is raising interest rates. This is a new environment. The Fed hasn't raised rates for a number of years, certainly not in an aggressive sense. And at the same time, they're also cutting back on liquidity with it's not quantitative tightening, but they're just ending the quantitative easing. Now, as you guys know, the Fed is actually ending its quantitative easing. We are not tightening. We are not reducing the balance sheet yet. That hasn't even started. In fact, the quantitative tightening hasn't even, or the end of quantitative easing hasn't even started yet. Well, the end has, but we haven't got there. So in March, finally, the Fed is going to buy its last bonds. So it's still, if you like, growing the balance sheet up until March. There's talk about them raising rates. Currently, the market has priced in about 100 to 125 basis points of rate hikes through 2022. And that would take the Fed funds rate somewhere in the mid ones. Okay, so still, perspective here, folks. It's one and a bit. Inflation's at 7%. I don't quite know how you spin this, but there's no other way to spin it than it's not really tightening of a kind that we're traditionally used to, simply because of the fact that rates are only going to go to 1.5. Maybe they may get to 2. I don't know, something like that. Who knows? I never call a top in rates. But I think there's a lot of people who are looking at this from a super hawkish point of view and forgetting the fact inflation is up at 7, which still gives you a negative 6% real yield at the moment, which is exceptional by any historic standards. So are they, am I super bearish about the Fed and super hawkish? Is the Fed super hawkish? No, of course not. And for those of you that look further afield, I think, when you look at what's happening with the ECB, I was laughing at some of the commentary the other day saying that Lagarde is seen as being hawkish for the ECB. Hawkish because interest rates have moved from minus 30 basis points to 0. Well, I don't know what book the press and the journos are coming from, but it's not the book of hawkishness that I normally read. Hawkishness, given 5% inflation in Europe, would be having interest rates at between 3 and 6%. We're not even at 0, for goodness sake. So, when people say this stuff, maybe a little bit of perspective is sometimes quite useful here, right? So there's reasons why interest rates are so, at the front end have a negative, such a big negative real yield. And I think it's got something to do with working off debt burdens. Is going to start raising rates and they're going to stop printing money. So that is a factor that's been affecting the market. The second thing that everybody keeps talking about and keeps worrying about is the risk of recession. And maybe we'll have a quick look at how that happens, right? So normally when you have a recession, let's mention the third thing as well too. Of course, the third item is that obviously inflation is out of control. Now we'll come back and look at inflation in a minute. So let's start talking about recession. So there's two ways that you think about recession. One of the early leading indicators of that is the shape of the yield curve. Now, we did this last week. For those of you who attended the yield curve, for those of you that didn't, please go back and look at it. It's in your membership that you can see that in the library. I recommend you swing by and look at that for half an hour, and then you'll understand what I'm talking about. For those of you that still don't understand it, then I'm afraid you're going to have to do a bit more homework. But really, what the predictor is that if there's going to be a recession, then the yield curve starts to rise and rise quite dramatically. If you look at this, the grey vertical lines are pretty much all of the previous recessions, and you can see, like clockwork, the yield curve has been steepening, if you like. Yeah, the yield curve has been steepening in every instance to actually create this this recession indicator. Okay, so and you can see, looking back at the chart, and this is printed by the Federal Reserve of St. Louis, right? So we're currently at the very top end, the right-hand side of this chart, and you can see there's absolutely nothing. The yield curve is flat as a pancake. There is nothing to see here. It's not a leading indicator of recession. Is there saying anything that's going to change that? I don't know, but quite frankly, there's nothing out there that's saying to me right now there's going to be a recession anytime soon. One of the other indicators as well too is something called the leading indicators, which is a publication that again, it comes out every single month, and again, leading into that, you would expect to see the leading indicators turning down and turning down aggressively. That's a sign. Leading indicator, it's a sign that there's a chance of recession turning up round the corner. So what's going on with leading indicators right now? Well, you can see if you look at the far right hand side, yes, it has been turning down, but turning down from where? From quite a high level. And is it turning down in any aggressive format, in any aggressive way, in the same way it has done when you go through this chart of previous recessions? And the short answer to that is no, it's not of the kind. You know, we're nowhere near. Yeah, sure. We all saw what happened at the beginning of 2020, right? That's a very good, if you like, indicator of this indicator to say that when that happens, you'd expect to see some kind of recession. Possibly had the shortest recession in living memory, hence the reason why we have out of control government spending and also significant inflation now, because they eased a little bit too quickly, given the and too much, given the state of the outcome of the pandemic. But look, point is, there is absolutely no sign right now that recession is around the corner. Okay, and the third point around this, right, is quite relatively straightforward to see. Everybody's saying, oh, inflation's out of control, it's going to go up and up and up and up and up. Well, okay, maybe, but there's actually a 5.5-year cycle. For those of you who want to pull the data down from the Fed database, you can have a look at it, and you can very clearly see the 5.5-year cycle. Let me have a quick look at this in a minute. And it's a turning down out of that cycle movement. It's turning down, starting to turn down between now and July. So I would expect to see the inflation rate start to decline quite significantly from about here until really pretty much the end of the year. So that could happen two ways. You could have the growth of inflation, the month-on-month rate start to come back, go flat and then turn negative, which would then bring the overall inflation increase down, if you like. So we go from 7 to maybe 5 or 4 or something like that. Or we could do this more aggressively, and we could have significant cuts in the rate of inflation, because the month-on-month figures turn down quite aggressively. So I would expect there to be a gentle decline down. However, who knows? And one of the things for sure is it would be a surprise at this point if we saw inflation start to run away from its current 7% level to higher rates. I don't see that happening. Maybe it does. I don't see that happening. And if it did, you would expect to see the Fed at least attempting to respond to the market with slightly higher interest rates. And again, that might well in itself start to cause some kind of recessionary impact. One of the things that we keep on having this debate around on this Trader Cafe, and I continue to mention it, and I think it's really important, is the fact that at the end of the day, interest rates in the long run, in the long end of the market, are still trading at around about 2%. That's the 10-year and the 30-year rates are within whatever, 0.25% of 10%. Okay, so, sorry, 0.25% of 2%, I apologize. So really, if the market is trading at 2% for 10 years, then what in heaven's name is inflation either doing at 7 or the expectations for inflation doing at 7? And I think this is the key thing, right? When you look at some of the inflation protected securities, and you look at some of the tips and what they're saying for inflation break evens over the course of the next 5 and 10 years, they still keep coming out with levels of about 3%. So this year could be an outlier. The expectation is from the bond market that interest rates are going to remain relatively low, because inflation is going to come right back to relatively benign levels in the 2 to 4 category. So just bear that in mind. So when we're looking at this 5-year inflation, this is what I'm saying. So you can see here on the right-hand side, courtesy of a piece that Larry Williams did the other day, you can see that during this, we have this cycle starting to turn down, and it is about now. So in the next 6 months, we'd expect to see inflation start to reduce. Okay, so when we think about what's going on in the stock market, okay, let's just remind everybody. I'll just come out. Oh, could I come out of this for a second? Maybe I can. Just hold on. I think if I just did this, just hold on for 2 seconds. Let's pull up the stock market. Okay, so we can see the stock market, just as a quick reminder, the stock market peaked in the end of the year, or the end of last year, beginning of the year. This year at about 4,800. We're now sitting at about 4,300, 4,350. So that's a correction of like 8, 9, 10%, right? Okay, so what's the significance of these corrections? So what's the difference between a correction and a bear market? Well, the normal standard definition is somewhere between 15 and 20% is considered to be a full bear market. In order to get to 15 or 20%, and don't forget, we're looking at the S&P 500 here. There are indices out there that are doing slightly worse than that at the moment, but there's clearly other ones that are doing slightly better, right? Which is why that sort of makes the economy, if you like, in terms of the way things are. So when we look at this, we're about 10% down roughly. Now, again, conflict with Russia, all bets are off. I don't know, we could go down to 20%, who knows? But realistically, for the time being, has the market corrected enough? And that's really the question that I'm trying to answer here. So let's have a quick look at some of these odds, right? So, since 1971 to 2021, there have been 33 corrections in the stock market. One thing I know for sure is there have not been 33 recessions in the last 50 years. That would be weird. So out of those, 7 actually turned into a bear market. Okay, 26 went on to new highs. Okay, that gives you, just from the correction, the average correction, which is around about 12%, pretty much where we are now, right? That gives you a 1 in 5 chance of it turning into a bear market. So an 80% chance of it not turning into a bear market and going on to make new highs. Okay, so just absorb that information. Okay, you have a 1 in 5 chance of it turning into a true bear market. Again, caveats this time around. Stock market's expensive and we have a potential conflict. Okay, so that might be a spanner in the works, right, so to speak. So we just have to be careful about how we're trading, but quite frankly, we have to be conscious of this information, right? So in those 7 bear markets, okay, it took over 475 days to end on average. Bear markets don't just happen quickly. The March 2020 bear market was an exception to the rule because of a sudden exogenous shock from the pandemic that allegedly was going to affect the economy and prevent economic activity taking place. Traditionally, when you have an armed conflict, you actually seem to have more economic activity because you have to make more things because they're blowing them up, I guess you could argue. So it's actually quite good. Bad thing to say, it's quite good for economic activity, but you guys know what I'm talking about, right? So when you look at this, you go, okay, so the short answer is you've got plenty of time. Okay, if this is really going to be a bear market, you have plenty of time. You have plenty of time to wait for the bounces and to sell every bounce, because there will be many over 475 days, and some of them will be quite aggressive. The average correction was 35%. So where does that get us? So we had the S&P up at 4,800, right? So half of that is going to be 2,400. So about a third of it is going to be about 3,200, something like that. So I would expect to see, if we're going to have a really bad bear market, well, a really bad bear market is going to be between 50 and 60% on the indices, but 35% is about average. So we'd expect to see the market, when it gets down to that 35%, to be attractive then, right? So that's something to bear in mind if we turn into a bear. So those of you who feel that 1 in 5 is coming true, then this is your target. Somewhere between 35 and 50 is the point at which stocks get interesting. Okay, So that's my little ditty on the stock market. So when we think about that in basic terms, guys, what we're really saying with this is either got to start going back up, or will start going back up from here and the correction will be over. Or we may turn into something different. Two different pathways, a bit binary in some respects, right? Because what you're saying is it either goes down now or it doesn't go down. So this is how we can use our technical analysis, how we can use our tools that we have to try and help us to discover when the bottom may be forming. You know, normally you tend to get those blow off, you get the very aggressive. Bear markets are often really aggressive, right? So you tend to get those aggressive price actions, volatility increases, the market will put short-term lows in place, and that could be the short-term low. So as we go through, just bear these things in mind. So let's pull up the stocks again and say, where would a decent, just from a technical analysis, if we went again, you know, this is a weekly chart, right? This is a weekly chart of the S&P. If we got back up to the high that we had just before we broke down in 2020, that's about 3,400. So we've still got room to go to get to our 35%. So somewhere between 35% and 50% would get us down all the way back down to the low that we put in place of March of the pandemic, when the pandemic first came out. So as we wipe out all of this existing run that we've had the last couple of years. Okay, so that having been said, where are we sitting at the moment? So this is the weekly chart of stocks. Now, we had a couple of weeks of bounces after the initial sell-off, and now we're starting to reach for lows again. So last week was a new low close. Obviously, don't forget tomorrow the markets are shut because it's a holiday in New York. This is the daily chart, and you can see from the daily chart we haven't quite hit a new low for the move in terms of closes. There's one more that we've got to get through from a closing perspective, but there is room down here. Hey guys, and something else to bear in mind, right? And I think you need to be aware of this, right? I think the last 2 weeks have seen the most inflows into the stock market, the US stock market, that's been seen for something like 10 years in terms of localized recent massive inflows. It appears that people are switching out of bond markets, the US bond market, into stock markets. So they're averaging in. What they're doing, or averaging in, they're putting more money in at the moment. Now, traditionally, when you see that happen, this is normally a really bullish sign. Okay, does it mean to say the market's going to rally tomorrow? No, it doesn't. It just means to say that people are looking at the opportunity and going, right, the market's come off a lot, I'm going to invest some more money. Does it work? Most of the time it's an amazing indicator and it works really well. So fund flows are really important. I don't know how it's going to spin out from a technical basis in terms of how this market trades, but you could make an assumption that that is actually quite a bullish signal. Okay, so why is it such a bullish signal? Well, I'll give you a second example. Okay, let's go look at gold. Everybody knows what's going on with gold at the moment, right? It doesn't take an expert to see that we've had a lot of up days, very few down days. Even the outside bar down day we had 3 or 4 days ago was wiped out. It took 2 days to get through it. Obviously, super bullish signal the minute we traded above it. Okay, those of you who trade outside days would know that's a super bullish signal once we trade above it. Okay, so if you look at this, what people probably aren't aware of is in this time frame down here, there was a couple of days when the inflows, the buying in the gold market was the largest that had ever been seen ever. I mean, like, I think there was something in the order of 25 or 30 tons of gold bought on one day alone. So again, when you look at that, yes, that takes the gold market short, but it doesn't necessarily mean the market's going to rally that day. Okay, but what it does do is make a big statement that somebody is prepared to bet on gold and bet on gold big. And you can see what happened to gold subsequent to that. So yeah, these flows matter, right? Now, are you going to be able to see all of these flows? No, you're not. Are you going to be able to track them? Yeah, you can track them through news headlines. The big inflow weeks and months, right? You'll see those because people will talk about them. The big days in gold that got distributed widely. If you're following gold, you would know that those things had happened. Okay, really important. I had a number of sources that told me that this was what was going on. So when you look at it and see those kind of inflows, gold was boring up until that point. It was doing nothing, and now all of a sudden it's trading up. So here's the thing, right? We haven't really talked about, this is us, by the way, starting to scoot around markets. Here's the gold market. Okay, when we go look at the weekly chart of gold, what are we seeing, right? We know that this has been in a crazy consolidation for like ever and ever and ever. Okay, you know, those of you who follow Ainsley's been talking about this as being really boring for a long period of time. What are we doing now? We've got to close up here, testing the previous high point up here around 1900 to 1930. Okay, what other information can we come up with that makes it look interesting? Well, I'm going to just see if I can put up some of the charts. So just bear with me for 2 seconds while I flick it onto my other chart package. Just hold on. Okay, here we go. So this is the same weekly chart of gold. On the bottom line, the blue line is the commercial positions. Now I know for those of you that follow this, Ash will be covering this for you. But as you can see, we have a significant, okay, at the moment it's, look at the numbers on the right hand side, it shows that we have it's a significant short position, but you have to bear in mind that most of the time gold runs in a short position because the gold producers will sell gold to hedge their longs that they're getting when they mine it. So there's a core amount of shorts that are built into the market. What we're looking at is the pattern from recent years, and you can see the market has got up to this point. It's reduced its short position, but really nothing has changed here for almost the last year. This to me is a really bullish sign. If I thought that gold was looking toppy, then this would be much higher, right? We'd have a much higher basis of the short position, so they will be much greater. It will be way down here, okay, way down here. But in fact, what we're doing is we're coming into this market with a small amount of commercial short positions, not a big amount of commercial short positions. That suggests to me the market is either balanced or sort of long. It's a bit arse about face when you think about it, but sorry, excuse my French, but the really what I'm trying to say here is at this stage, what we would expect to see if the market was going to top out would be significant increases in short positions, and we're not seeing that on the commercial side. It's boring, which is fundamentally very bullish. Okay, when we start to see this blue line dip down aggressively, this is a time at which the market makers or the producers will be getting more and more short. Okay, so what does that mean? Is they're happy to sell into the higher prices. At the moment, they have no inclination to do it. That to me is another bullish sign. Okay, so now we've talked a little bit about the future outlook for gold. You've seen how it looks on the daily charts and the weekly charts. So I hope that covers it. Does anybody have any questions about gold? Gold for a while has looked so boring that it's been terrible. Now we're getting, and we did point this out a few weeks ago, guys, 2 or 3 weeks ago, we were saying we were having a series of higher highs coming into the market, and now look what's happened. So this was coming. We've talked about this quite a lot in the last 2 or 3 weeks, saying there was an opportunity here, and it's delivering. Okay, so as we roll up, we're looking at that. Now, what's really interesting is when you look at this. Now, hopefully this works for me. Okay, this is I'll just put it up here. This should be good enough, and I'll change this to a line chart just to really illustrate the point. This is a chart of platinum against gold. So when I look at the precious metals market and I have a scoot round, what I'm really trying to do here is I'm saying, well, what's the best precious metal to buy? What's the cheapest precious metal? What I see here is gold is looking really solid. Gold is looking really positive. But actually, when you look at this relationship, you can see that in actual fact, platinum has been underperforming gold for quite some period of time. Now, platinum is a core part of the energy transition. You need a lot of platinum for the products that are going to help you decarbonize. So as a result of that, platinum should be trading better. So why isn't it? Okay, I'm not quite sure about that. What I do know is looking at this chart that platinum is cheap versus gold historically. We're looking at a daily. I think if we go to a weekly, it looks even better. Just bear with me for a second. Let me just see what I can get up. So this is we aren't as low as we have been, as we could be, but certainly platinum is not expensive as it was up here in 2017, 5 years ago. Okay, so I see this trend restoring itself and platinum outperforming going forward from here on in. Okay, for those of you that want to trade it, there's a ETF in the States called PPLT, I think, is the platinum ETF, and there's also futures as well too. So you should be able to get it on most of your good CFD broker outfits. They should do platinum for you to have a look at. Okay, right, that's gold covered, and we'll just take one more thing as well too. Is I just want to look at just to show you what's been going on with the gold miners. Again, when we look at the gold mining indices and we go back a little while, you can see that they are not expensive. And when you compare them in broad terms against the gold itself, the product itself, they've actually corrected more. So I believe that gold stocks are actually cheaper than the gold product itself. Why, I'm not too sure about. Their margins are just brilliant at the moment. I would have thought their valuations would be up here, but they're not. They're unloved. Nobody likes them. Just bear that in mind, that now we're starting to see some price performance. People have noticed that gold mining stocks are relatively cheap relative to the market and relative to gold as well too, the precious metal itself. So again, GDXJ are two of the ETFs around the mining stocks. Go and have a look at those, see what you think. I'm just saying they're cheap. I'm not saying whether they buy themselves. I'm not allowed to, but you guys can make your own mind up. Again, looking at that chart, use the tools that you have available to see that probably there is something new happening there rather than something old. Again, the market might turn down. There's a caveat to everything, but for the time being, this appears to be something new taking place. Okay, now, foreign exchange. We always run out of time with this stuff, guys. We've been at this for half an hour. We always run out of time, so I've got to make this super quick. Okay, what am I seeing in foreign exchange at the moment? I made a list. Here's a list for you. So this is what I do on a Sunday evening. I go around, scoop around the markets about things which are interesting. Okay, significant markets that I think are going to move. Dollar yen. I worry a lot about dollar yen. At the moment, it looks like it's overbought, and it could easily correct very aggressively. So I am a seller of dollar yen, a buyer of Japanese yen. Why is that? Well, let's go have a quick look at the market and see if we can see something. Just bear with me again while I pull this up. And actually, I'll pull that up and let's just kill the, just hide that. Hi folks, we're back again. I do apologise. For some strange reason my computer decided to dislike me an enormous amount and just decided to shut down these days. So just bear with me while I get us back going again. And so we were talking about dollar yen, and I was saying I think at this point, I can't tell you when, timeline wise, but I'm actually fairly confident at the moment that I think that there's something new going on with the dollar yen. And I believe that there's a risk it's going to trade lower. So we might not be able to have the possibility of looking at all of the charts. I'll do my best to get them back up as we come back into the market again. And I apologize, I have no idea why suddenly we aren't talking to each other, but these things happen. So we just have to be a little quicker. That's the answer. So just bear with me for 2 seconds. Okay, let me just share the screen here. Just hold on. Sorry about this, team. I hate technical issues. Okay, so when we look at this chart, right, we're back sharing again. When we look at this chart here, this is a chart of, it looks a bit weird because it's dollar yen inverted. So this is the CME quote for Japanese yen. So the reason why this is a bit weird is they quote it on an American basis. So what I'm interested in is what's going on with those commercial positions. So again, you can see the blue line on the bottom. This is telling me that commercials at the moment are substantially long of Japanese yen. They've been building up positions of Japanese yen. And as a result of that, so think about this the other way, they are going shorter and shorter and shorter of dollar yen. You just got to think about it the opposite way around. So when we look at that, what does that mean? Well, I can't tell you when, and I can't tell you how, and when it's going to happen. Let's just have a quick look and see what some of the momentum looks like here as well too. And I'll just move this up here so we don't get it out the way. When I look at some of the momentum charts as well, hold on. Okay, what I'm seeing here in the moment is momentum is, as dollar yen keeps rising, the momentum is not rising with it. So you can see this blue line where we just get the thing here. This is momentum down here. Okay, so as dollar yen keeps going up, we are not seeing the performance from the market. So if I just put dollar yen up here rather than having this the way around, we get this right. Just hold on. Chaotic tonight. Absolutely chaotic. There we go. Much better. So you can see here momentum is starting to break down. So we've got bearish momentum divergence occurring in dollar yen. Just thinking about that and what that's going to look like. It's really turning around saying, well, actually, I think there's a risk that dollar yen starts to fall back. So just go back to the weekly chart again, and seasonals again when we look at that yen. So yeah, so at the moment we've got the commercials are accumulating shorts in dollar yen. Don't know when it's going to turn around. Momentum is telling you it's starting to turn around now, so that's on my watch list for troubles going forward. So let me just make this all a bit bigger. Wow, we are absolutely crazy today for what's going on. Okay, right. So other things that are interesting to me at the moment. Hopefully we can make this a little bit easier to understand. So Aussie dollar. Aussie dollar is at the moment, right? What are we seeing in Aussie dollar? We are seeing a substantial build up of commercial positions. You'll see this down here. Right, and again, this time, this is quoted the right way round for us. So what we're seeing here is the market has come down. There's been substantial longs have been built up in the market. None of those have been unwound. What is that saying to me? It's saying that Aussie dollar right now is cheap. Looks like it's going higher. When we look at the New Zealand dollar as well too, we're getting a similar pattern. in terms of the build up as well too. Not quite as dramatic, but it's a similar build up as well too. So what I'm seeing here, right, is the way the market is appearing right now is Aussie dollar, New Zealand dollar are cheap. Let's prove something just to prove to you that this is, hopefully it's still working around the seasonal stuff. And the COT report is to go and have a look at my old friend, the old mucker, coffee. What's going on there? So when you look at the weekly bar chart of coffee, coffee now has some of the most significant short positions that have been built up for 10 to 15 years. Okay, so what am I saying about coffee? Coffee, I think, is probably done. I always said in my head, for those who've been following me for quite some time, 2 or 3 years now, I've been bullish of coffee from 100 up to 250. Now I'm sort of at 250 and going, well, what next? Well, right now, what I'm seeing is a market that's massively overbought. I think there's going to be some kind of correction. I'm not sure when. Use your technical tools. I think there's a short here for those of you that are interested in trading some of the commodities. What other things have I got? We could go around them, but I'm really worried about time. I need to wrap up in 2 or 3 minutes. So sterling New Zealand, it looks like we got bearish momentum divergence there. I'm figuring that sterling Kiwi could be down. And Aussie Kiwi is down. There's bearish momentum divergence there as well too. So this is really saying that the New Zealand dollar is going to outperform against both Aussie and the sterling. So that's quite good. I quite like it when I have 2 or 3 charts saying the same thing. Again, timing wise, stop losses, everything else, you've got to manage that yourself. But that's the percentage direction movement that I'm seeing at the moment as well too. For those that are really interested, you can go and look this up, or maybe ask Ash if he comes in to do one of the other sessions on the commitment of traders. I would also look at, so again, it supports our thesis around gold and precious metals, that they're going up. One interesting thing that I have picked up this weekend is that US Treasuries, so 10-year notes, are sitting there with a significant long position on from the commercials. So what does that mean? It means that possibly prices are at their low and yields are at their highest. So we might see, don't know when that's going to happen. You might argue it's a bit too early yet because we're only in February. We might well see those 10-year yields starting to top out and the price is starting to either go sideways or else start to rally. Now, why would that happen? Why would long-term interest rates start to fall here? Well, that will probably be a sign that maybe something else is going on that recession question we looked at earlier. These are things to watch, right? But one of the things we do know is on the short-term cycle, it appears some of the bond market sell-off that's been taking place may be a little overdone, maybe starting to reverse. Guys, I think that's about it for me done. Does anybody have any questions about anything I've asked? I apologize for being a bit confusing around the dollar yen. I know what I'm trying to say, and hopefully that came across. So I'm bearish on US dollar yen, okay, because I'm bullish on Japanese yen. I believe that the Japanese yen is going to rally, and that may be against some of the crosses as well too. So watch out for that. And I believe that dollar yen itself is probably going to top out here and reverse. Okay, just coming through on the chat now. Okay, thanks so much. Yeah, look, I always appreciate the comments. Anything you got to say, good and bad, is always quite handy because it means I can get just a little bit better next time. Yeah, so look, the Japanese basket is near those yearly lows. Just have a think about that. There may be some seasonal work you got to do to try and check out whether this is the right time for Japanese yen to rally. But you know, all of these things are like ingredients. Okay, what you're doing is you're setting up the market. You're setting it up to really give you the best possible opportunity you could to make money. Sometimes you need to have like some kind of spike or extreme take place in the market to confirm your view. Sometimes the market just rolls over, doesn't give you the opportunity. So there's always different ways to try and do this, but what it really does is it protects you from your position. Yeah, look, I had and somebody's asking about the euro. We'll have a quick look at the euro now. Again, it's quite easy because we have quite a cool thing in that it's actually quoted the right way round in Chicago. So yeah, I'm seeing here, I'm not seeing anything from the commitment of traders side, right? It's literally sitting right in the middle. It's neutral. Yeah, there's a tendency, I guess you could argue there's a tendency for it to sort of be a little bit different, but I'm not getting anything, guys, right? Having a slight short position on the commitment of traders report from the commercials is about as boring as it gets, right? No extreme. What I'm always looking for, right? And this happens about once a quarter to 2 or 3 markets. You get these crazy extremes, right? You get commitment of traders, the commercials sitting with extreme positions. That's when I get really interested. What comes out of that is a multi-week positional trade. Okay, not a daily, but a multi-week positional trade. So I always try and look for the easy ones out there, and I can't see anything in the euro at the moment. And it's not that surprising if you think, because their pace of interest rate differences between the US and the European markets is not that great at the moment. So if the US raises 25, probably the Europeans might start to raise interest rates just a little. They'll lag by a bit, but they'll probably start to raise. So is that slightly bullish for the US dollar? I think so. I think it's slightly bullish for the US dollar. But again, if the economy starts to recover, trade goes a bit wider. So you then have the countervailing forces of trade balance and stuff like that. And quite frankly, a rising currency, a falling US dollar is very good for the world economy. You want that because the US needs to export its dollars around the world because the world is still significantly short of dollars. I won't get into that conversation. We've covered that a couple of times in the past. Not really going to talk about it here. So look, guys, I think that's probably it for me. If there's no other questions, we'll wrap it up now. And I hope that gave you a flavor for the way I'm looking at things, a bit more of a foreign exchange bias this time. And again, if there's any topics that you'd like to cover, I'm really happy to. We've done the sentiment cycle recently. We've done a quick teaching on the yield curve. And today we've just had a scoop around the markets, but talked a little bit about sentiment and a little bit about the way the markets are set up, right? That's the key thing. So lots of things going on. And yeah, look, I could do a US dollar session. I think really when I think about these things, for me, I try and look at them for opportunity's sake. And that's really what I'm trying to do. So I try and when I scoop around the markets, I'm trying to find things which make sense to me. Sometimes that happens in currencies. Sometimes it happens in some of the commodities. Again, if you're tracking the gold at the moment, very clearly that's been a breakout move, right? So do we expect that to continue? Well, who knows? But you can look at that chart and figure out where the major resistance points are. You guys are just as good at this as I am. Oil. Somebody's asking about oil. Gary, oil really fits into that world. Aren't they going to do something about Ukraine? I think what I would do about oil is really simple. We know it's overbought. We know that if the Ukrainian situation resolves itself, then most likely oil will take a setback. It's a little bit expensive. And if you look at the shape of the curve, it's still quite heavily backwardated. So at the moment, there's a belief that there's a shortage of oil. I don't really hold there to be a belief. I think it's a perception that there'll be disruption if there's a conflict. Okay, so then with that caveat, just go and look at what happened about 5 or 6 weeks ago. Gosh, I think it was 5 or 6 weeks ago, possibly a little bit longer, when you had those two spike days down in the 60s for oil, right? You saw a significant breakdown and the market came straight back again, right? So what you can see with that, when you start, we should see a market extreme of some kind, and then the market will start to maybe roll over and start to reset itself for a new trend. But right now, very obviously the trend is up. Very obviously you're buying dips. There's no change to that. If the market pauses, that'll give an opportunity for you to potentially put another position on if you're thinking about being long, because it's still a bullish situation. Okay, I would expect if Ukraine resolves itself for the market to come back. And again, if it doesn't, then that's got to be a bullish signal, hasn't it? So just bear these things in mind, right? Always think, well, hang on a second. If the war genuinely is over, then surely the normal supply chain reasserts itself. Everybody calms down. There's plenty of oil around, and the market will then come off, won't it? Because all demand is still lower than it was back in 2019. Okay, so there's not really a shortage of oil out there. There's a shortage of capacity at Cushing, I get that, but there's not really a shortage of oil per se. So I think it's being emotionally driven higher on the back of worries about the Ukrainian situation. So that's all I can really say at the moment, and just wait for that technical spike. Yeah, and look, Orlando, yeah, I agree with you as well too. This thought process is all about gold. It's this, some people saying it's a similar thing. I view it's completely differently. One of the reasons maybe why oil isn't doing so well right here, right now, is that everybody is long of it. Okay, the market's been trading up for some time. One of the interesting things about gold is I don't think anybody has it. right? Oh, and I appreciate it. I thought we were talking about gold as well. Okay, no worries, Orlando. It doesn't matter. I'll add this caveat in as well too, right? So look, here's the thing, right? If nobody owns this stuff and then it starts to go up, is that the beginning of a bull market or the end, right? If everybody owns oil and it doesn't really perform too well, despite the fact that Russia's about to start invading Ukraine, then what does that say about the future for oil? That's how you have to think about this stuff, right? This is when fundamentals and thought processes collide with market price action. Okay, so it doesn't require a massive amount of thought. We just got to think a little outside the box about what's going on. You know, put down your Twitter feed and just sit down and consider what's happening, okay, with all the news that's happening out there in the round, not individual and what individual people are saying. Just look at the headlines in a broad way. If you can interpret them correctly, some days it's very difficult to interpret because the news people get very excited. Remember that stuff about a hawkish ECB? Utterly insane. How can you be hawkish at 0% interest rates? Right, Mai's telling me I have to wrap it up. Guys, look, thank you very much. I hope you've enjoyed this, and I'll see you in 2 or 3 weeks' time.